Hello and welcome to the Financial Times and markets here in New York. Well, summer is done. We're now into September and a big week beckons. We've got the ECB and investors asking the big question at the moment, will they do or won't they do QE? And then on Friday we have the monthly US payroll report, which comes at a very interesting time for markets when we look at both equities, high-flying equities, and we also look at bond yields, which continue to drop. Joining me now to discuss what we can expect possibly this week is Vivianne Rodrigues, who's part of our US markets team here in New York. Vivianne, thanks for dropping by. So what do you make of this rather interesting chart we have? I sort of call it the crocodile jaws. It's one of my favorite charts at the moment because you have the top jawline effectively being the S&P at 2,000, and then you have the lower jawline, which is that dropping or declining 10-year note yield, which last week got down to around about 2.3%. It's backed up a little bit now today to around 2.4. What do we make of that jaw? That sort of, are they about to drop or basically close, and which asset class is a possible victim here? I love
this chart, just like you, because it just tells you how, first of all, people were absolutely, completely wrong at the start of the year saying that U.S. Treasuries were going to sell off. And we actually see absolutely no sign of that abating, at least when it comes to Treasuries. And then we just hit another 2,000 points on the S&P 500. And guess what? Treasuries continue to rally, right? So when we talk to people in the markets, all they say is just that there's two different stories here. A lot of people say interest rates are not going to go up anytime soon, even if the Fed starts, pushing the rates up in 2015. This is not affecting the U.S. Treasury market right now. Stocks, different game, valuations, I won't get into that. But what you see is that, it's just basically, a free-for-all in the bond markets. I mean, you can sell as much debt as you want, you can buy as much debt as you want, because look at the returns in Treasuries and corporate debt.
And we've seen a big start to the first week of September here today.
It's a gigantic week. I mean, September is usually a very strong month in terms of primary issue calendar, right? Last year, actually, we had record sales, period. But we also had Verizon alone with 49 billion.
That's right.
But just by making a quick round on the syndicate desks today, they're saying that this week, with only 4 days, we can get to 25 billion. And if the stars align, maybe we can top the $150 billion mark again by the end of the month. And we have 9 central bank meetings, ECB, as you said, Thursday, and the Fed. I mean, you pay more attention to the Fed. People, maybe expecting the Fed to be a little bit more hawkish. I don't know.
No, it really seems to be the ECB's in the driving seat here, and it's pushing European bond yields lower and lower, and in turn, that 10-year Treasury and also the 30-year Treasury bond yield keep coming down as well. It's like they're all part of this global anchor, and they've been pulled lower. And indeed, investors seem to be looking at low-yielding European bond yields and saying, I get a better deal than the US, I get high yield, and I also get potentially a currency pickup if the dollar continues to strengthen, because the ECB is diverging from the Fed. So let's turn to this other chart, which shows what we've been seeing in terms of monthly payrolls for the last 6 months. We've had now 6 consecutive months of 200,000 plus job gains. And economists this week expect that August will also be the 7th month in a row where we've been above 200,000. And yet, if you look at the performance of the 10-year Treasury yield, it is actually sold off before every payroll report and subsequently hit a new low for the year. Do you see anything changing after this week's report?
I don't think so. Not at least for what people are telling us. I mean, people keep saying that the only thing that can really, rock the boat at this stage is geopolitics, right? If Putin really decides to keep the escalation in Ukraine going on, if other tail risk wins, you start, rocking the boat here. But when it comes to interest rates, some people expect the Fed maybe, they say a bit more hawkish, to acknowledge the labor market improvement, to keep saying that the U.S. economy keeps getting better, which they have been saying for a couple of months now. But they don't expect this is going to deter people from keep piling on the U.S. Treasury market, on the corporate debt market. And you mentioned something interesting, and I have a question for you. Interest rates are, yields are super low in Europe. The dollar is rising. So why we keep seeing all the Yankee issuance? Right? Why you will be contracting, debt in dollars, in a currency that is appreciating, especially when yields are also very low in Europe?
Well, one of the things I've heard from some people in the last week or so is that European banks are under pressure to diversify their funding sources. So there is a movement to go and tap the dollar market. and that seems to be dry. It seems to be coming from a regulatory impetus as well. So it's definitely something to keep an eye on.
So that's one of the reasons why most of the Yankee issuance is coming from the bank financial side.
Exactly. I mean,
because you're right, companies seem to be borrowing in Europe.
Yep.
The banks seem to hit in the US market.
It seems to be a diversification play and sort of spread your funding around across regions. Well, we'll see what happens this week.
Yeah.
Thanks for joining us.
My pleasure.